The RRSP is the most hated account in the entire Canadian FIRE movement. People call it a trap. They say your money's locked up. They say the second you touch it, the government takes a brutal cut. And here's the uncomfortable part. The people saying that are going to retire with tens of thousands of dollars less than the people who quietly figured out the thing I'm about to show you. Because there is a way to pull money straight out of your RRSP and pay basically zero tax on it. Not at 65. Not when the government decides you're old enough to retire. Years before that. And the reason you've never heard of it is simple. You've been learning about early retirement from Americans. This move does not exist in their country, it only works here. Stick with me for the next few minutes because the window this opens up is way bigger than almost anyone tells you. So, let's start with why the hate exists, because it's not totally wrong. The fear goes like this. You spend 30 years stuffing money into your RRSP, it grows into this big number, and then in retirement, the government forces you to pull it out, and every dollar you withdraw gets added to your income and taxed at your regular rate. Now stack on top of that your CPP and your OAS. And here's the kicker. At the end of the year you turn 71, you're forced to convert your RRSP into something called a RRIF and start draining it on a schedule, whether you want to or not. So you've got CPP, OAS, and mandatory withdrawals all landing in the same year, all piled on top of each other, all taxed together. That's how people end up paying more tax in retirement than they expected. That fear for a normal retiree is real. But here's what nobody connects. That nightmare only happens if you wait. And if you're chasing FIRE, financial independence, retire early. You're the one person on the planet who doesn't have to wait. Let me draw you a timeline because this is the whole secret right here. Say you hit financial independence and walk away from work at 45. Put that on one end. Now the earliest you can start CPP is age 60. OAS normally kicks in at 65. And that forced RRIF conversion we just talked about, 71. So look at the space between 45 and 60. That's 15 years. 15 years where you've stopped working, so you've got no salary coming in, and the government checks haven't started yet. In those years, your taxable income can be almost nothing. You're living off your TFSA, which is tax-free coming out, and your regular non-registered investments. Neither of those shows up as much income, which means every single one of those years, the bottom of the tax brackets is sitting completely empty. In Canada, you can earn roughly the first $16,000 and pay basically no federal tax on it at all. That's the basic personal amount. Every adult gets it. Every year. So here's the question that unlocks everything. If you've got all this empty zero tax space every year, why would you let it go to waste? This is the move. It's called an RRSP meltdown, and once you see it, you can't unsee it. Instead of letting your RRSP sit there growing into a tax bomb that goes off at 71, you deliberately drain it, slowly, during those low-income gap years. Here's how it plays out. Every year in that window, you withdraw an amount from your RRSP that roughly fills up that empty zero tax space. So you pull out around the basic personal amount, and the tax you owe on it comes out to almost nothing. Then you take that money and you either live on it or, and this is the smart part, you reinvest it straight into your TFSA, where it grows tax-free forever and never gets taxed again on the way out. So think about what you just did. You contributed that money years ago while you were working, at a 40% plus tax rate, and got a fat deduction for it, and now you're pulling it back out at basically zero. That gap, high rate going in, near zero coming out, that is the strategy. That's free money the tax system is leaving on the table for early retirees specifically. Do this for 10 or 15 years, and by the time you hit 71, there's barely anything left in the RRSP to force convert. The tax bomb never goes off. You diffused it one quiet year at a time, while everyone else was telling you the account was a trap. Now, I'm not going to pretend this is foolproof. There are 3 things that trip people up, and if you get them wrong, the comments section of every other video will happily watch you fail. So let's get them right. Number 1, withholding tax. When you pull money out of an RRSP, the bank holds back a chunk on the spot, 10, 20, or 30% depending on how much you take. Don't panic. That's not your final tax bill. If your real rate for the year is basically zero, you get that money back when you file. It's a cash flow timing thing, not a real cost. Just don't be surprised when the full amount doesn't hit your account on day 1. Number 2, the room is gone for good. Unlike a TFSA, when you pull money out of an RRSP, that contribution room disappears permanently. You can't put it back later. That's totally fine here because you're in drain mode, not save mode, but know that the door only swings one way. Number 3, don't overshoot. The whole point is staying inside that low or zero tax space. Pull out too much in one year, and you climb into the higher brackets and start paying real tax. The art is taking just enough each year to fill the empty space, and not a dollar more. Get those 3 right, and the strategy basically runs itself. So why have you only ever heard about this from a Canadian, never from those giant American FIRE channels? Because their version is a clumsy workaround called a Roth conversion ladder, built around totally different accounts and a 5-year waiting rule. Their whole system is wired differently. When you watch their videos, you're getting tax advice for a country you don't live in. The RRSP Meltdown is the Canadian answer. Same goal, get your money out early and cheap, just built for the system you're actually in. So that's the move everyone told you didn't exist. But there's a question this opens up that's almost more important. Once you're retired early, which account should you actually drain first? Your non-registered, your RRSP, or your TFSA? Pull them in the wrong order and you can quietly hand the government thousands you didn't owe. That's the order I'm breaking down next. If you want it when it drops, you know where the subscribe button is. It's right there. No pressure. Either way, now you know the window's open. Most people never find out.